bottom. But when you see one, you know that a big reversal is probably at hand. Bullish divergences occur towards the ends of downtrends, they identify market bottoms. A classical bullish divergence occurs when prices and the oscillator both fall to a new low. Rally. With the oscillator rising above its zero line. Then both fall again. This time, prices drop to a lower low, but an oscillator traces a higher bottom than during its previous decline. Such bullish divergences often precede sharp rallies, figure 23.3. I'm showing you this weekly chart of DJIA and its MACD histogram as a perfect example of a divergence. It deserves to be pinned to a wall near your trading desk. You won't always get such a perfect picture, but the closer you get to it, the more reliable it'll be. Notice that the breaking of the centerline between two indicator bottoms is an absolute must for a true divergence. MACD histogram has to cross above that line before skidding to its second bottom. If there is no crossover, there is no divergence. Another key point, MACDH gives a buy signal when it ticks up from the second bottom. It does not have to cross above the centerline for the second time. The buy signal occurs when MACDH, still below zero, simply stops declining and traces out a bar that is less negative than its preceding bar. This divergence of MACD histogram in figure 23.3 was reinforced when MACD lines traced a bullish pattern between the bottoms A and C, with the second bottom more shallow than the first. Such patterns of MACD lines are quite rare. They indicate that the coming uptrend is likely to be especially strong, even though we cannot call them divergences because this indicator has no zero line. The rally that began in 2009 lasted almost a year before its first meaningful correction. Also, we can't call the pattern of lower indicator tops after the bottom C a divergence. The lower tops reflect the gradual weakening of the uptrend with the passage of time. In order to count as a divergence, MACD histogram has to cross and recross its zero line. A bullish divergence. Here you see a divergence that signaled the 2007 to 2009 bear market bottom, giving a strong buy signal right near the lows. In Area A, the Dow appeared in a free fall, as Lehman Brothers went bust and waves of selling hit the market. The record low A of MACDH indicated that bears were extremely strong and that the price bottom A was likely to be retested or exceeded. In Area B, MACDH rallied above its centerline, breaking the back of the bear. Notice that the brief rally reached the value zone between the two moving averages. This is a fairly common target for bear market rallies. In Area C, the Dow slid to a new bear market low, but MACDH traced a much more shallow low. Its uptick completed a bullish divergence, giving a strong buy signal. Bearish divergences occur in uptrends, they identify market tops. A classical bearish divergence occurs when prices reach a new high and then pull back, with an oscillator dropping below its zero line. Prices stabilize and rally to a higher high, but an oscillator reaches a lower peak than it did on a previous rally. Such bearish divergences usually lead to sharp breaks. A bearish divergence shows that bulls are running out of steam, prices are rising out of inertia, and bears are ready to take control. Valid divergences are clearly visible, they seem to jump at you from the charts. If you need a ruler to tell whether there is a divergence, assume there is none, figure 23.4. The previous chart featured a striking bullish divergence at the 2009 stock market bottom. Now, for a similarly striking illustration of a massive bearish divergence, let's roll back the clock and examine the 2007 bull market top. Notice that the breaking of the centerline between the two indicator tops is an absolute must for a true divergence. MACD histogram has to drop below its zero line before rising to the second top. Another key point, MACDH gives a sell signal when it ticks down from the second top. We don't need to wait for it to cross below the centerline again. The sell signal occurs when MACDH, still above zero, simply stops rising and traces out a bar shorter than the preceding bar. The message of a bearish divergence in figure 23.4 was reinforced by MACD lines, which traced a bearish pattern between the tops X and Z. The second top of MACD lines was more shallow than the first, confirming the bearish divergence of MACDH. Such patterns of MACD lines tell us that the coming downtrend is likely to be especially severe. Missing right shoulder divergences in which the second peak fails to cross the zero line are quite rare, but produce very strong trading signals. An experienced trader can look for them, but they are definitely not for beginners. They are described and illustrated in the ebook Two Roads Diverged: Trading Divergences. Kerry Levorn performed extensive research to find that the most tradable divergences occur when the distance between the two peaks or the two bottoms of MACDH is between 20 and 40 bars, and the closer to 20, the better. In other words, the two tops or two bottoms cannot be too far apart. 20 bars translate into 20 weeks on a weekly chart, 20 days on a daily chart, and so on. Kerry also found that the best signals come from divergences in which the second top or bottom is no more than half the height or the depth of the first. A bearish divergence. In Area X, the Dow rallied to a new bull market high and MACD histogram rallied with it, rising above its previous peak and showing that bulls were extremely strong. This indicated that the price peak X was likely to be retested or exceeded. Note that the top X of MACDH, despite its complex form, was not a divergence because the valley in its middle never sank below zero. In Area Y, MACDH fell below its centerline, breaking the back of the bull. Notice that prices punched below the value zone between the two moving averages. This is a fairly common target for bull market breaks. Notice also a kangaroo tail at the bottom Y. In Area Z, the Dow rallied to a new bull market high, but the rally of MACDH was feeble, reflecting the bull's weakness. Its downtick from peak Z completed a bearish divergence, giving a strong sell signal and auguring in the nastiest bear market in a generation. Triple bullish or bearish divergences consist of 3 price bottoms and 3 oscillator bottoms or 3 price tops and 3 oscillator tops. They are even stronger than regular divergences. In order for a triple divergence to occur, a regular bullish or bearish divergence first has to abort. That's another good reason to practice tight money management. If you lose only a little on a whipsaw, you will preserve both the money and psychological strength to re-enter a trade. The third top or bottom has to be more shallow than the first but not necessarily the second. The Hound of the Baskervilles. This signal occurs when a reliable chart or indicator pattern doesn't lead to the action you expected and prices move in the opposite direction. A divergence may indicate that an uptrend is over, but if prices continue to rise, they give the Hound of the Baskervilles signal. This signal is named after the story by Sir Arthur Conan Doyle in which Sherlock Holmes was called to investigate a murder at a country estate. He found the essential clue when he realized that the family dog didn't bark while the murder was being committed. That meant the dog knew the criminal and the murder was an inside job. The signal was given by the lack of expected action, by the lack of barking. When the market refuses to bark in response to a perfectly good signal, it gives you the Hound of the Baskervilles signal. This shows that something is fundamentally changing below the surface. Then it is time to get in gear with the new powerful trend. I am not a fan of stop and reverse orders, but make an exception for the Hound of the Baskervilles. On those rare occasions when a bearish divergence aborts, I may go long. In the rare instances when a bullish divergence aborts, I look to go short. Part 4. Computerized Technical Analysis. Chapter 24. The Directional System. The directional system is a trend-following method developed by J. Wells Wilder, Jr., in the mid-1970s and modified by several analysts. It identifies trends and shows when a trend is moving fast enough to make it worth following. It helps traders to profit by taking chunks out of the middle of important trends. How to construct the directional system. Directional movement is defined as the portion of today's range that is outside of the previous day's range. The directional system checks whether today's range extends above or below the previous day's range and averages that data over a period of time. These complex calculations are best performed on a computer. The directional system is included in most programs for technical analysis. 1. Identify a directional movement, DM, by comparing today's high-low range with yesterday's high-low range. Directional movement is the largest part of today's range outside of yesterday's range. There are 4 types of DM, figure 24.1. DM is always a positive number, plus DM and minus DM refer simply to movement above or below yesterday's range. 2. Identify the true range, TR, of the market you analyze. TR is always a positive number, the largest of the following 3. The distance from today's high to today's low B. The distance from today's high to yesterday's close C. The distance from today's low to yesterday's close. 3. Calculate daily directional indicators, plus DI and minus DI. They allow you to compare different markets by expressing their directional movement as a percentage of each market's true range. Each DI is a positive number, plus DI equals 0 on a day with no directional movement up, minus DI equals 0 on a day with no directional movement down. 4. Calculate smooth directional lines, plus DI13 and minus DI13. Smooth plus DI and minus DI are created with moving averages. Most software packages allow you to pick any period for smoothing, such as a 13-day moving average. You get 2 indicator lines, smooth positive and negative directional lines, plus DI13 and minus DI13. Both numbers are positive. They are usually plotted in different colors. The relationship between positive and negative lines identifies trends. When plus DI13 is on top, it shows that the trend is up, and when minus DI13 is on top, it shows that the trend is down. The crossovers of plus DI13 and minus DI13 give buy and sell signals. 5. Calculate the average directional indicator, ADX. This unique component of the directional system shows when a trend is worth following. ADX measures the spread between directional lines plus DI13 and minus DI13. It is calculated in 2 steps. Calculate the daily direction